One of the most common questions we get from investors and potential investors is it risky to invest? Now, despite the evidence that investing can have a huge benefit to your financial journey, only 51% of Australians hold investments outside of their home or super. In this video, we'll explain why investing in shares may not be as risky as some people think. Share market investing is often characterized as a high-risk activity. The risk we're talking about here is the risk of losing your money. You might have heard horror stories about poor investments based on stock tips that end up being worth nothing. And yes, if you don't do your research or invest in accordance with your risk profile, someone could get hurt, and that someone is likely to be your hard-earned savings. This chart here is a foundational investing concept that can help you think about risk. Every investment can be plotted along the axis of this graph, mapping an investment's risk and return. Risk measures the chance that your investment will fall in value, while return is the potential investment gain you might make on your investment. At the bottom of the risk scale is cash. You can store it under your bed and it'll be worth the same amount when you wake up the next morning. It won't grow in value, but it also won't shrink. At the top end of the risk scale, we have cryptocurrencies or your friend's uncle's tech startup. There's no guarantee that you'll get a good return or even that you'll get your money back. But there is a small chance that these speculative investments do pay off and provide large returns. So the question is, where do shares sit on this risk scale? If you're selecting a random listed company, your odds probably aren't too good. In 2018, an academic paper entitled "Do Stocks Outperform Treasury Bills" was published. The research found that between 1926 and 2018, more than half of US shares have negative lifetime returns, and that when returns are rounded to the nearest 5%, the most frequent investment outcome are returns of negative 100%, a complete loss of investment. So from this result, it sounds like investing in shares is basically as bad as gambling away your money, but the truth is a bit more nuanced. The largest 500 companies listed in the US, as measured by the S&P 500, saw average annual returns of 10.3% between 1926 and the end of 2023. So returns in shares have a skew towards larger and more established companies. Furthermore, a small number of these companies are also responsible for the majority of investor wealth creation. Investors can look to this list of more established companies which have driven the US economy over time to make the odds of losing money lower. So how do you get exposure to these sorts of companies? Well, one way is to buy an index tracking ETF. ETFs are designed to give you exposure to a basket of shares in a single trade. They can hold the largest companies listed on an exchange, a country, or within certain sectors. This helps reduce the risk that your investment will lose money. By increasing your exposure to multiple holdings, instead of a single share, you're basically reducing the risk that a failing company will completely wipe out your investment. And aside from losing your money entirely, the other key risk here is that your investment falls in value and you're forced to sell it before it has the chance to regain that value again. How often does that happen with shares? Let's use the example of the largest 200 companies listed on the ASX. This index of companies has yielded negative returns in 5 of the last 30 years. Buying and selling within those years would have meant a capital loss, basically a loss of your investment. Different index ETFs will have different risk and return profiles. So a sector ETF that holds volatile technology shares, like those in the NASDAQ 100 index, will hold more risk. But the caveat to investing in shares is your personal investment timeframe. Here are the returns of the ASX 200 and the NASDAQ 100 in the last 30 years. Despite the difference in risk and return and declines in value, the trend is upwards. It indicates investment growth. This can give share investors a general peace of mind, because over the long term, broad equity indices tend to increase in value. So if you're in the accumulation phase of investing, that is, you're still growing your wealth, you could be holding your investments for 10 years or more. And based on that holding period, investors are well positioned to ride out volatility, whereas those with shorter time horizons are more susceptible to incurring losses. But sometimes the biggest risk is actually not investing at all. Long-term investing into markets has been a proven strategy to slowly grow wealth, and missing out on that can be costly for your financial future. If you're looking for a simple way to invest in index-based ETFs, you can do that through our investing platform, BetaShares Direct. Direct offers zero brokerage on ASX-listed ETFs, along with features like fractional investing and automated deposits to help you on your wealth journey. You can check that platform out via the link in the description. Thanks for watching, and we'll see you in the next video.